Ever wondered how to quickly improve your credit score? It's a question that's probably crossed your mind. After all, a robust credit score is the key to unlocking many financial doors. Whether you're eyeing a new car, a home, or a loan, a good credit score can make a world of difference. But how does one go about enhancing it and fast? In this video, we'll break down the process of boosting your credit score into simple, manageable steps. Before we delve into how to improve your credit score, it's important to first understand what a credit score is. Essentially, a credit score is a numerical representation of your creditworthiness, calculated based on your credit history. It's a three-digit score that ranges from 300 to 850, with higher scores indicating better credit health. Lenders use this score to assess the risk of lending money to you. It helps them decide whether to approve your loan or credit card application, and at what interest rate. Your credit score is determined by several factors. The most significant is your payment history, which accounts for about 35% of your score. Another key factor is credit utilization, or how much of your available credit you're using. This makes up about 30%. The length of your credit history, the mix of credit types, and new credit inquiries also play roles. Now that we understand what a credit score is, let's move on to how you can improve it. The first step to improving your credit score is paying your bills on time. This step may seem obvious, but it's crucial. Timely bill payment accounts for about 35% of your credit score. When you pay late, it gets reported to credit bureaus, and this can negatively impact your score. It's like a smudge on a clean white shirt. It stands out and it's hard to get rid of. So, how can you ensure your bills are always paid on time? Well, one way is by setting up automatic payments. This means the money is automatically deducted from your account on a set date. This eliminates the risk of forgetting to make a payment. Another method is to set up reminders on your phone or calendar. These alerts will remind you when it's time to pay a bill. Remember, consistency is key when it comes to bill payment, so keep those payments steady and watch your credit score rise. The next step is to lower your credit utilization. Now you may ask, what on earth is credit utilization? In simple terms, it's the percentage of your total available credit that you're currently using. It's crucial to your credit score because it tells lenders just how reliant you are on credit. Think of it this way. If you have a credit card with a limit of $1,000 and you've spent $500, your credit utilization is 50%. The lower this percentage, the better it is for your credit score. How do you lower your credit utilization, you ask? Well, one strategy is to pay off your debt as quickly as possible. Another is to avoid maxing out your credit cards. Try to keep your spending well below your limit. Remember, your goal is to show lenders that you can manage your credit responsibly. By keeping your credit utilization low, you'll be well on your way to a better credit score. Another important step is to keep old credit cards open. You might wonder why. Well, it's all about your credit history. This history is not just about how well you've managed your credit, but also how long you've managed it. The longer your credit history, the better picture lenders get of your long-term financial behavior. That's why keeping that old credit card open can be beneficial. Now, let's address a common misconception. Some believe that closing old credit cards that aren't in use can improve their credit score. But remember, closing an old credit card may shorten your credit history and potentially lower your credit score. It's like erasing a part of your financial journey that lenders want to see. Keep in mind, every financial situation is unique. If an old card has high fees or you're struggling to manage multiple cards, closing it may be the best move. But generally, maintaining older credit accounts can be advantageous. So think twice before you close that old credit card. The final step is to limit new credit applications. Each time you apply for a new line of credit, be it a credit card or a loan, your credit score may experience a temporary dip. This is because lenders perform what's known as a hard inquiry on your credit report to determine your credit worthiness. These hard inquiries can lower your score by a few points and remain on your credit report for 2 years. Applying for credit should not be a casual decision. It's crucial to only seek new credit when absolutely necessary. Resist the temptation to apply for that store credit card just to save a few bucks today. Instead, focus on long-term financial health. Also, it's wise to space out your credit applications. Rapid, multiple applications can be seen as a sign of financial distress, further negatively impacting your score. Remember, a little patience can go a long way in improving your credit score. With these steps, you're now equipped to start improving your credit score. Let's recap. Pay your bills on time, lower your credit utilization, keep your old credit cards, and limit new credit applications. Each step is crucial in its own way. and together, they form a solid strategy to boost your credit score. Remember, it's a journey, not a race. Consistency is key. Thanks for watching. If you found this video helpful, please give it a thumbs up and subscribe to our channel for more financial tips.